Alrighty. So in today's video, we're going to be talking about one option strategy that you can use for retirement, right? So if you're the kind of person that, you don't like to trade many different kind of strategies, you just want one strategy that you can trade over and over again, and you were to ask me, what would I suggest? Then I would say it would be this strategy. So what is this strategy? Well, this strategy is what I call the put ratio spread retirement strategy, right? So we're going to use the put ratio spread and trade it in a way where it will suit our retirement purposes. So first of all, what exactly is the put ratio spread? So if you're not familiar with the put ratio spread, the way that I like to see it is a combination of two different strategies, right? Two different strategies, both are simple on its own. So the very first strategy is what is called the short put, right? So with the short put, when you sell the put option, you're going to receive a premium for it, right? So this is the first part of it. You're going to receive a credit for selling this put option. Now, with this credit that you receive, what you're going to do is that you're going to buy a put spread, right? So this is what you call a put debit spread or a long put spread, or you can also call it, the bear put spread. So for this long put spread, what's going to happen is that you're actually going to pay a premium for that. So the whole idea down here is that you're using the premium which you receive for the short put to finance the purchase of the long put spread, right? So as you can see down here, you will have two short puts and one long put. So when you combine it together, basically it will look like this. So the whole idea down here is that the short put part of the long put spread, as you can see over here, is actually sharing the same strike price as the one short put on the left hand side, right? So if you combine them together, you will see that there are two short puts at one strike, and then on top of it you have one long put, right? So some people take a look at this and they say, hey, there's two short puts, isn't it double the risk? So it's not double the risk, because for one of them you actually already have this long put, right? So it's being covered by this long put. So how you want to see it, again, like I mentioned, you want to see it as a long put spread and then one additional short put at the side. Okay, so this is the put ratio spread. So again, the whole idea down here is that you're using the short put to finance the purchase of the long put spread. So here's an example. So let's say you sell one short put, right? You sell the short put and you receive $3 in credit for it. So for every short put that you sell, that is $300 you're going to receive in premium. Now, with this $3 credit that you receive, you're going to use a part of it to buy the put debit spread, right? So as you can see down here, if you buy the long put spread for $1, then the overall spread, the put ratio spread, when you combine them together, the total credit you're going to receive is $2, right? So that means you're going to receive $200 per put ratio spread. So this is the whole gist of the put ratio spread, how you're going to construct it. Now, you might be asking, hey Davis, why do I want to add the long put spread, right? Wouldn't it be much more simpler if I just had, just the short put? And that is a good question. So there is a reason why we want to use the long put spread, and that is because we want to use it as a defensive measure, right? Because one of the things that a lot of people are afraid of whenever they, do the short put is, what if the market comes down? Right? If the market comes down, this is where they're going to panic, right? Because they got a short put, they don't want the market to come down, so they, are afraid, right? But with the put ratio spread, you have this long put spread. So it is like a defensive measure. So in case if the market actually comes down, we actually have like a semi-hedge in place, right? Not a full hedge, of course, a semi-hedge, in a sense whereby if the market comes down, you can actually still make some profit from the put debit spread portion, right? Because the put debit spread is a bearish strategy, right? So the short put is a semi-bullish strategy, right? Depending on how far away your short put is, but generally it is a neutral to bullish strategy in the sense whereby you want the market to go up to make money. Whereas for the long put spread, it's very clear cut that you want the market to go down in order for the long put spread to make money. So what you have down here is a combination of a bullish and a bearish strategy. So whenever we put on any strategy, of course, if you put on a bullish strategy, we want the market to go up, right? But how good are we in picking the direction, right? If you're already so confident thinking that the market is going to go up, then don't get into options, right? Just buy the stock outright the market, if it goes up, you're going to make even more than just selling the put option. So the reason we want to put the long put spread in place is also because we're not very sure if the market really will go up, right? Nobody can really predict the market 100%. I mean, if you can, then of course you're a genius. You should be a millionaire by now or a multi-billionaire by now. You shouldn't be watching this video, right? But for the most part, all of us mortals, the rest of us, we're not sure. So we want to have this long put spread as a defensive measure. The market comes down, we can still make some profit on that put debit spread. And at the same time, if the market goes up, we will actually still be in a profit, right? Because remember, we receive a credit for this whole put ratio spread. So we're not that worried. And if the market comes down, we actually also look forward to it because we have the long put spread in place. Now, the next question you might have is, Davis, how do I make money with this strategy? So there are a few scenarios that we actually can profit with this strategy, and I'm going to share it with you, right? So the very first scenario is if the stock actually expires above the put ratio spread, right? So this is our structure down here. So anywhere above this structure, it will expire worthless, right? Basically because, it did not come down, right? If it did not come down, the profit which we're going to get is pretty much the full credit that you receive for putting on this strategy. So if you recall the example earlier, I said that, you put up this put ratio spread, you receive a total credit of $2, right? So for every put ratio spread, you will receive $200. So this is a very straightforward scenario. Now, scenario number 2, what if the stock actually goes below the long put, but it actually stays above the short puts? So right now, as you can see, it actually went in between our structure down here. So at this point of time, what exactly do we do? So if you do actually have this scenario, it actually is good for you, right? Because you are actually going to be in a profit as long as it stays somewhere there close to expiration, right? So once it's near expiration, all you got to do, right, is just close out the whole spread, right? Close out this put ratio spread for a profit, right? So as you can see down here, this is the P&L graph of the put ratio spread. So as you can see down here, there are 2 puts down here. So this corresponds to this one down here. And then you have 1 long put. So this 1 long put is down here. So you can see down here, this is where the market price is, right? So this also, coincides with where the current market price is down here. So that means to say, if the market actually comes down here and stays between the put options, right? That means the 2 short puts and the 1 long put, you are actually going to make more than if the market actually went up, right? So you can see down here, if the market actually went up, all you're going to get is just the credit which you receive for putting on this strategy. But as the market actually comes down, you notice that the max profit is actually near where the short puts are, right? In fact, the max profit is right at where the short put is. So if it actually stays between these 2 puts down here, then actually you will be in a better profit, right? Let me just draw a line down here. So somewhere down here, or let me just shade it, this whole area down here, right? As long as it's below the long put, above the 2 short puts, then your profit is going to be greater than what you would get if the market goes up, right? Basically, you get more than the credit. So why is that so? And the reason is because, remember, I told you about the long put spread. When the long put spread is in play, when the market comes down, the long put spread actually helps you make money as well. So that is why you actually make more than if the market was to go up and you just receive the credit, right? So if you think about it this way, you're actually paying money for the put debit spread. So if the market actually goes above the put debit spread, so let me just remove all this again. So let's say if the market stays above the put debit spread, your put debit spread actually lost money because you actually paid for it, right? So you actually do not get anything from the put debit spread. You lost whatever you sort of, used to finance this put debit spread. But if the market comes down, now your put debit spread actually makes money. So down here, you have a combination of 2 things. You have the credit, which you receive upfront, plus you get a profit for closing out the put debit spread, which is in profit. All right. So this is for scenario number 2. Now, scenario number 3, what if the stock actually goes below the put ratio spread, right? So if you were to just go back to this graph down here, you notice that even though if it goes below the put ratio spread, that means, let's say, for example, somewhere down here, let me just remove this drawing again, and I'll draw this. So that means we just go slightly below the 2 short puts. If you actually go slightly below the two short puts, you notice that at expiration, we're actually still going to be in a profit, right? At this point down here, it's going to be, a pretty nice profit, but we actually do not want to hold it to expiration. Why is that so? Well, because if you're going to trade this on individual stocks, right, or even on index ETFs, these two short puts is going to get assigned at expiration, right? So for scenario number 3, if the stock goes below the put ratio spread, what we want to do is that we're going to separate this strategy into the two components which we talked about, right? The short put and then the long put spread, because now we're going to manage them separately. So bear with me here, just really pay attention to this part because it's quite important. So the first step you want to do, once the market actually goes below the whole put ratio spread construct, that means below the short put, this is where your put debit spread will be in a profit. Now at this point in time, you can actually close it out for a profit. Now that you have already closed out the put debit spread, you are left with just the short put. So what do you do with the short put, right? So there are two methods that you can do right now. Number one, you can leave it to expiration, because remember, the whole idea down here is that you actually do not mind getting into the long stock position, right? The way we want to trade put ratio spread is a way whereby we don't mind getting into the stock, and then if we are in the stock position, the market goes up again, we're going to profit on the shares that we got assigned on. So method number one, you leave it to expiration. Two things can happen. The first thing is that if the stock goes back up by expiration, that means it expires actually worthless, then you actually do not have to worry about anything, because right now you made the full profit on the short put side, because the credit whatever you receive, you got it, and then you also sold the put debit spread, you got a profit there as well, right? So this is a good scenario for you. Now the second scenario after using method number one is that if the stock stays below the short put at expiration, you will get assigned, right? You get 100 shares, and this is actually what we want. So remember, the whole idea of this put ratio spread strategy is we actually don't mind getting into a long stock position, right? A very simple way is to just get into the shares if the market goes up, and then you get a profit from there as well. Now, method number two is that you can actually roll the short put, right? So how do you roll the short put? You can roll the short put simply by rolling out to a further DTE and to a lower strike price. So for example, if there's maybe, let's say there's 15 DTEs left in this short put, right? And then you just roll it. So what you want to do is you want to roll it to maybe a higher DTE. So it depends on what you can get, right? And also how low of a strike price you want to go to. But basically when you're rolling, you can actually get an additional credit and at a lower strike price. So maybe this time you want to roll it to 30 DTEs, and then you want to roll the strike price further down, right? So whatever the price is. So maybe if originally it was $50, then you want to roll it down to maybe $48, depending on what you can get on the option chain. So when you do this, you can actually get a credit. At the same time, you leave more room for the market to actually have a possibility to go back up. Then this whole short put again will expire worthless. Now, what if it goes down? Well, if it goes down, then guess what? You can go back to method number one again, right? Method number one, that means you can either just leave that to expiration, see whether you get assigned, or if you can roll it again, you can choose to roll it even further down. And if you get assigned again, this time you will get a lower strike price, right? You will buy the shares at a lower price. So this actually is a very good scenario for us, because if you actually get assigned the shares and then the market shoots back up, you make on a lot of ways, right? You make on the put debit spread, you also receive the credit for the short put, and then for the shares, you're going to make profit if the market goes up, right? So there'll be a capital gain. So at this point in time, you might be asking, Davis, this sounds all fine and dandy, right? It sounds so good, but where is the risk in this strategy? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Well, that's a very good question, because we must always find out what is the risk in the strategy. And the risk is if the market keeps going down, right? So for example, in scenario number 3, you get assigned the shares. The market keeps going down. So if the market keeps going down, you're going to start to lose on your shares, all right? So in this case, what do, right? How do you reduce the risk? Okay, so I'm going to share with you a few ways that you can reduce the risk. So really take some notes if you can. So the very first thing you want to do is to keep a watch list of stocks that you actually don't mind owning, right? So ideally, you want to go for fundamentally good stocks or index ETFs, right? So if you go for stocks that you know in the long term is going to keep going up, you actually do not mind getting into the long stock, right? So for some people, they like to, buy more speculative stocks. So for example, I've had people that say, I like GameStop, right? They're waiting for Roaring Kitty to maybe suddenly come up with a tweet, the stock shoots up, right? That's all up to you, right? Basically, you want to keep a watch list of stocks that you do not mind owning. So even though if you're long the stock, you're okay with that. Now, the next way that you can reduce the risk is to actually identify the stocks that are currently undervalued, right? So you already have a watch list of the stocks you don't mind owning, and most of them hopefully is fundamentally good stocks. Then what you can do is that you can go to some of the sites down here, right? For example, simply Wall Street or Guru Focus or Morningstar, so on and so forth, right? There are a number of these sites where they actually, tell you what is the value of it, whether is it undervalue or overvalue. Now, each site have their own valuation. So what you want to do is that you just want to go through, all the sites and then just maybe get an aggregate of it, or just find the one that has, the one that makes sense to you most, or whereby, you find one where the fair value is the lowest. All right. So out of those stocks, you want to find the one that is undervalued, because now you have an additional defense mechanism, right? Because you may have actually fundamentally good stocks that you want to go long, which you don't mind owning the shares. But if you get it at a price where it's too expensive, right? If it's above the fair value, then it could take quite some time before the market comes back up again if it keeps going down, right? And that is why, if you find it undervalued again, then this would be one other way that you can further reduce risk. Whereby if you actually do get long, let's say for example, you get assigned on that short put, you now at least have the conviction to hold on to those shares because you can see that it's undervalued, right? So for example, as an example, we're just going to use this price, right? For some people, if you find this too expensive, go for the cheaper stocks, right? So let's say, for example, for this, you can see that the fair value down here and the current price is quite a big difference, right? So if you think that this fair value is pretty accurate, then even though you get assigned at the current price, you don't have to worry, right? You can just hold on to it, right? For example, in 2022, where a lot of the stocks, right, they went so far down that, a lot of people panic, they close out their stocks. But if you already understood the stock that you're buying, the company, and you think that it's undervalued, you can hold on to it, and then the market will eventually come back up as it did, right? As you can see in 2023, 2024, the market just shot back up. That is why, certain stocks like Google, Meta, Amazon, if you had entered them at a price where, it was undervalued, then you definitely would have the conviction, holding power to hold on to it until the market eventually comes up. Now, the third one is to wait for a good setup, right? So we already have quite a number of defensive measures. Now, this will be the final defensive measure, right? So what is a good setup? So this is something that I've talked about in quite a number of videos. So this is a very good way, especially if you're new to trading options, then this good setup you can use is number one, just put on the stochastic oscillator. Right, so the stochastic oscillator basically just measures the condition of the market, right? Is it overbought or is it oversold? So as you can see down here, I've circled it in red already. As long as it goes below this line at the bottom, it's considered oversold. That means to say that the market has already sold off quite a bit, and the chances of it, going back up at least would be slightly better than if it were to continue going down, right? Of course, that is not to say that the market won't continue to go down. It can, right? But you've already reached a point whereby it's really pretty oversold, right? And you've got these 2 points down here as well that gives you further conviction that if you're assigned, you can hold on to it, right? So if it's oversold, definitely it's a much better position for you to put on the put ratio spread than if it's overbought, right? You notice that every time if it's overbought, take a look at the chart, right? This is where the market has gone up quite high, right? That is why the stochastic label it as overbought, right? So if at this point, if you were to put the put ratio spread right? The market could just come tumbling down very quickly, and you may not necessarily be, comfortable holding on to the shares if you get assigned, right? So wait till the stochastics oversold. And next one, the final one, identify support level. So if the oversold reading is not enough, you also want an additional defensive measure whereby you find places where the prices find it very difficult to go below, right? So these are what you call support levels. So you can see that prices have bounced off several times, and then it went back up. Now it come back down, and then it's about to test this support level. Right, so doesn't mean the support level is going to hold all the time. It's just that, again, everything about trading and options is about probability. At least you have a better chance of it going up. So if it does go up, then the whole put ratio spread expire worthless. You just make the full credit that you receive for putting on the put ratio spread. But if it does go down, despite all these measures that we have in place, and then now you're assigned the 100 shares, then guess what? You are already at the point whereby the market is pretty oversold, right? It has gone through quite a bit, and that is not to say it won't go further down, but there is a chance that there could be a retracement back up, right? Or even a reversal. And at the point, as long as you are in a profit, you can choose to close out those 100 shares. All right, so once you've identified all this is where you can construct the put ratio spread, right? Basically, you want to construct the put ratio spread below this support level. Okay, so I've already given you quite a number of defensive measures that you can use to further reduce the risk of this strategy. So now let's get into trade construction, because this is where a lot of people will ask me, Davis, so for this strategy, what is the DTE? Which DTE should I go for? Should I go for 0 DTE or -1 or -7 so that my profit, would have been already realized before I actually put on the trade? No, okay, I'm just kidding, right? So the whole idea down here is that whenever people ask me DTE, a lot of times they want to go for the shorter ones. And yes, I understand why, right? We want to realize the profit very quickly. And here's the thing about this strategy. For the most part, whenever I talk about, DTE with a lot of the strategies that I shared on my channel, I tend to go for above 45 DTE because that's where our edge lies, right? The edge where the realized move is oftentimes lesser than the expected move. But for this strategy, the DTE selection is actually not that important because we actually don't mind getting into the shares, right? We don't mind getting into a long stock position. So with that said, there is still some difference between the shorter DTE and the longer DTE that you need to know in order to craft the put ratio spread according to your preference, right? So now let's talk about the shorter DTE first. So with the shorter DTE, you actually get a higher return, right? So you notice down here, the ROI is higher compared to this one. And how do you calculate the ROI? It's actually pretty simple, right? You just take the credit which you receive. You can see down here, 0.34, which is $34, right? And then you divide it by the strike price, right? Basically the cost of the amount that you have to put up to long 100 shares for this, right? So basically, if you were to just calculate ROI divided by the DTE times 365, that's how you're going to calculate the ROI. You will get a higher return than the longer DTE, right? As you can see down here, I compare it with a 29 DTE. But there are some slight differences where you might consider a longer DTE, right? So for example, you have lesser premium to purchase the long put spread, right? You can see down here, if you sell this 134 strike, you get only 34 cents. So 34 cents is going to be quite difficult for you to buy, a bigger put spread because you don't have that much credit. And at the same time, your put ratio spread is going to be closer to where the current market price is, right? Mainly your short strike, right? So if you will take a look at this down here, 134 is giving you only 34 cents. That means to say that if you want to go for a further strike, a further away strike, let's say maybe 130, you're not going to get that much credit already, right? It's going to be so little that there's no point for you to even put it on. But whereas for the 29 DTE, you notice that, hey, you get $2.43 for the same strike price. What does this mean? It means that if you were to go further out of the market, so maybe you can even go to 130, maybe 128, 127, and you find that there's still some credit. So why does this play an important part? Because if the market actually comes down and you reach a point where you want to actually get assigned or you have to get assigned, then Of course, you're going to get a better entry price if you get a further away strike price with the longer DTE down here, right? So if you're going to get a sign, is it better for you to get long at maybe the strike price of $127 or at $134? Of course, $127. So that is why, longer DTE will actually give you that better strike price if you are going to get into the long shares, right? So again, you get more premium to purchase the long put spread, and the put ratio spread is further away to market price. Only difference, or rather the small setback, is that it's a slightly lower ROI if you were to just get the credit. But for me, I value more towards the risk side, right? If the risk is to the downside, if I'm going to get into the long shares, I'd rather get it at a lower price than a higher price. Okay, so this is on DTE selection. Now next, let's talk about short put strike selection. Where are we going to position our short put, right? So there are two ways that you can do this. Now the very first way, very simple way, is just price selection. Basically, you choose the strike price at a place where you don't mind going long the shares at. So let's say, for example, it could be at a price of $50. So let's say, for example, you think that $50 is what you like, then you can place it at $50, right? If you are able to construct this whole put ratio spread for a pretty decent credit, right? So that's the first way. The second way is that you can use the delta to select your short strike, right? So you use delta as an indication of the percentage chance of being in the money at expiration. So let's say, for example, you want only a 25% chance that you could get breached on the short put side, then you get a sign. Then at this place, you can go for the 130 strike price. Now, the final component is the long put strike selection. So how do we define where we put the long put strike? So if you have a more bullish outlook, then this is where you want to go for the further out of the money strike, right? So as you can see down here, this is where the current market price is. So out of the money will be below this current price down here. So basically, the lower the price is, the more further away it is, and the cheaper the put, right? So if it's much further away, then you notice that the purchase of this put is going to be much cheaper. So you're going to get a higher credit for the put ratio spread and a lower max profit for the long put spread, right? Because your put spread right now is going to be smaller. So this is if you're more bullish. But if you're more bearish, you're not very sure, or you want to be more defensive, right? You're afraid that, the market is going to come down. Then in this case, you want to go for a nearer to where the current market price is, the strike price there. And it's going to be more expensive, right? As you can see down here, because you're going closer to the current market price. So at the money strike will always be more expensive than further out of the money. So for this, the good thing is that you have a much defensive structure if the market comes down. So you actually anticipate the market to come down. You want it to come down so that your put spread down here, you can get a much bigger profit, right? The trade-off is that you get a lower credit for the put ratio spread. That means if the market goes up, then your overall credit that you get is going to be lesser. As you can see down here, this is 50 cents. For the previous structure, you actually get much more, right? You get $2 if the market actually goes up. But for this, if the market comes down, then you're going to get a higher max profit for the long put spread. All right, so this is the put ratio spread retirement strategy. So use it and let me know what you think in the comments below. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.